Peter Schiff. This is Tuesday, July 28th, 2009. Well, looking at the markets, the Asian markets, the emerging markets continue to be strong. Looking at the mainland Chinese shares, they're up more than 100% thus far in 2009. I follow the Hang Seng quite closely. That index is up better than 90% now from its lows of October 2008. And I'm reading a lot of people warning now that to stay away from the Asian markets, the Chinese stocks, emerging markets, because they've had such huge rises. Well, that's true. They've gone up a lot. I've never seen the markets move up this much in such a short period of time. But you have to put the rise in perspective. You have to look at the decline that preceded it. The decline in 2008 was way out of line, and stocks got to fire sale prices. So the fact that they've moved up so dramatically has to be held in perspective to the decline, which was an overreaction to the problems in the United States. Remember, the Hang Seng, for example, was at better than 30,000, and it fell to 10,000, or just over 10,000. Now it's back up above 20,000 a year, but it's still 35% plus below or its peak from 2008, despite the fact that it's practically doubled. Now, many of the stocks, are not nearly as cheap as they were in late 2008, early 2009, but they're still not expensive based on PEs or based on dividend yields. But I did read something that said that if you look at the valuations of the emerging markets economies relative to developed markets, that emerging markets are the most expensive they've ever been, or close to the most expensive they've ever been. Now, my gut feeling is that that's not actually the case, because I think a lot of the earnings estimates for a lot of the emerging market companies are too low. On the other hand, I think a lot of the earnings estimates for the developed markets, particularly in the United States, are too high. So I don't think that the valuations are, as lopsided or as close as people think. I think that as the earnings estimates prove to be too optimistic for a lot of the U.S. companies and too pessimistic for a lot of the companies in the emerging markets, I think we're going to see that there's much more value in those markets than is currently perceived. But of course, it also validates what I was saying late last year, early this year, with regard to the sell-offs in these markets being overblown, and all the people that were trying to dismiss the decoupling view based on how much weaker foreign stocks were than the U.S. stocks. Hopefully these people are starting to come to the correct conclusion that the weakness was not a function of this codependence. It was more a financial situation, a deleveraging, and it was a financial, not an economic link that they saw. And it was very short-term in nature. Now, also looking at the situation in China, Chinese officials met with U.S. officials, Geithner, Clinton, in Washington, D.C. One of the things that came out of that meeting was that Treasury Secretary Geithner reassured the Chinese that the U.S. was going to get the deficit under control, because the Chinese, of course, are worried about big deficits because they're our biggest creditor, and they don't want to see the value of their investments diminished by inflation, by big deficits. And we reassured them that we've got the situation under control. Now, how they can believe that is beyond me. We don't have the situation under control at all. The deficit is spiraling completely out of control. It's going to be estimated at $1.8 trillion. But here you have the administration trying to promote socialized medicine, government-provided health insurance, all these other things that are going to increase the budget deficit, not shrink the budget deficit. How can we grow government on the one hand and then reassure the Chinese that we're going to get the deficit under control? If they actually believe that, then they're not nearly as smart as I give them credit for. I don't think there's a chance that they actually believe it. This is all smoke and mirrors. This is all PR. If we really were going to try to get the deficit under control, we would be doing it right now. We wouldn't be tolerating a projected $1.8 trillion deficit. We would be bringing it under control right now. And we wouldn't be planning this gigantic increase in government spending. All this would be on hold if we were really serious about the deficit. Now, also in this meeting, one of the things that came out of it, and you read some of the press reports, was that the Chinese were going to have to consume more, and the Chinese government was going to have to get their citizens to spend more, and we were going to have to get our citizens to save more and spend less. Well, that's what we need, but we're doing the opposite. We're discouraging savings by keeping interest rates too low. Why would people save in this country if they don't get a return on their savings? The stimulus is designed to stimulate spending, not savings. So we're telling the Chinese one thing, but our policy is the exact opposite of what we're trying to reassure them that we're going to do. And of course, I run an investment firm, and a lot of my clients are saving. But unfortunately, I have to encourage them to save abroad. I wish I could encourage my clients to save domestically, but I know that they can't do that because their efforts are going to be undermined by our government. Our government is deliberately debasing our money and destroying the value of our savings and undermining the capitalistic system and undermine the markets, which is going to impede the profitability of U.S. companies. So unfortunately, as a financial advisor, I have to tell my clients who are saving to save abroad or to buy precious metals. Now, in the short run, none of this is helping the economy. We need more people to save and invest in this country, but it can't happen if the government policy is undermining our returns and making it impossible for people to save here. And of course, when I read one of the news reports, there was an economic professor from Stanford University who was talking about how the Chinese were trapped, that they had no choice, that they had to keep buying these treasuries because if they stopped buying, their own currency would gain in value and they would export less to America. But that's precisely what needs to happen, right? If we want the Chinese to consume more, then they're going to export less. Because what they're going to do is they're going to consume what they produce instead of exporting it to us. And in order for that to happen, their currency has to rise in value. You see, for some reason, our economists think that if the Chinese consume more, they're going to consume more American products. Well, I've got news for those economists. There aren't all these American products for the Chinese to consume. As I've said repeatedly, if the Chinese consume more, they're going to consume more of their stuff. After all, that's what Americans are consuming. When we spend money, what do we spend it on? We spend it on Chinese products. If the Chinese start spending more money, why should we expect them to do anything differently? They're going to spend their money on Chinese products. Chinese to spend more money. What do we think they're going to spend it on? They're going to spend it on all the products that they're manufacturing. And so if they're spending the money and buying the products themselves, that means they can't simultaneously export those same products to us. And so they're not trapped. They don't have to keep buying our treasuries. If they stop buying our treasuries, we'll do exactly what Geithner is saying that they should do, spend more money. But of course, the short-term effect of that is going to mean that fewer products are exported to America, and the Chinese are not going to be buying as many U.S. Treasury bonds, which means Americans are going to be confronted with higher prices and higher interest rates, which is precisely what our government doesn't want to happen. So despite what they're saying, of course, they're working to get the reverse. Now, in the long run, this is going to backfire because the Chinese will eventually stop buying our bonds and start buying their own products and take care of their own standard of living and stop subsidizing ours. But then we're going to suffer even more because the longer this goes on, the worse shape we are in, the bigger the hole that we dig for ourselves. But it's amazing, again, that you got this Stanford economist so completely clueless on basic economics. But everybody is clueless about this, and unfortunately, we're all going to learn a lesson. I saw again today, I don't know if I linked it on my YouTube site. I'll try to find the video, but you can search it on your own. Someone else did a video again on Ben Bernanke and strung together a number of his predictions, all of which, of course, were wrong. Ben Bernanke has never predicted anything that ended up to be right. In fact, you can look at his predictions, and he's been completely wrong on everything he's ever said. And that's going to maintain based on what he's doing now. I mean, I think I once said on my radio show right here, I would love to see the clip of anything that Ben Bernanke ever got right. Anyway, that's it for this video blog. Thanks again, everybody. Don't forget, I'm doing my radio show, Wall Street Unspun, tomorrow on my website, www.europac.net. Until then, in my next video blog, so long, everybody.